Welcome to our class today. My name is Mark Triplett. I'll be your instructor. Our class is titled Social Security and Tax Strategies. We're going to cover a lot of ground today, but before we get started, just a couple of things, little items for some background. I'm a fee-based fiduciary investment advisor. We run a retail financial planning firm here in Ankeny, Iowa. We also have an office in Westminster, Colorado. I'm an investment advisor representative of an SEC registered investment advisory firm called Royal Fund Management out of Florida. We have investment advisors all over the country. Really the role that I play here is one of architect and design, helping our clients define where they want to go with their future, what that looks like, organizing the resources that they have, being proactive if we see something, say something, and then holding them accountable to make sure that they take the actions necessary to get to where they want to go. And part of that really is dealing with Social Security claiming options, as well as how to reduce taxes in retirement. So we're going to talk about some of those strategies today. Just a quick disclosure. Nobody on my team, including myself, is endorsed by any government agency or Social Security for that matter. We're going to use some hypothetical examples throughout the class today to teach some of the finer points of some of the strategies. These are hypothetical examples. We use some very basic assumptions. These are not real people. These are not our clients. Now, some of the frequently asked questions that we get in our classes, and we do live classes at a community college here locally. One of the questions that we get is, what is the best age to claim my Social Security benefits? Another question that comes up frequently is, how do I coordinate benefits with my spouse or my ex-spouse if I was married in the past? And we'll talk about that a little bit too. We also hear folks wanting to know, if I'm still working and earning an income, can I claim Social Security, and what would happen to my benefits if I did that? Another question that comes up quite often is, will my Social Security benefits be subject to tax? And if so, is there anything that I can do about it? And many folks really want to know, what strategies could I potentially use to reduce my taxes throughout retirement? And how will distributions from my other retirement assets, such as IRAs and 401ks and other pre-tax accounts, as well as after-tax accounts, affect my Social Security benefits? So we're going to cover all of these questions throughout the class today. Now, before we get too far down the path of answering any of those questions, let's just talk about the value of Social Security today, because Social Security, in our opinion, is a pretty good deal. The market for safety has changed. Places that were considered to be safe in the past, such as CDs and Treasury inflation protected securities, just don't offer the same rate of interest or yield that they used to. At one point, you could actually earn a fair amount of interest or get a pretty good yield above the rate of inflation. But today, that's just not the same situation. So this graph basically shows the fact that interest rates have plummeted over the years, and now most folks are just happy to put their money in a place where they know they can get it back and they're not going to lose it. And they may even be losing purchasing power due to the erosion caused by inflation or the rising cost of goods and services, because their money's just not working for them. So Social Security today as a resource for income in retirement is a pretty good deal considering the rate environment. Now, before we can really dive into some of the strategies on how to optimize Social Security for your household and how to reduce taxes, we have to kind of overcome a few myths about Social Security. And some of the things that we hear in our classes a lot are folks coming in with some preconceived notions because of what they've heard in the media. Social Security is going broke. It's not going to be there for me. The trust fund is almost empty. And there's some truth that without some changes, Social Security could look different in the future than it does today. But let's just address that. If you get your green and white statement from Social Security, there'll be some fine print disclosures on that statement that basically say something to the effect that if no changes are made to the program, that the trust fund will run out sometime early 2030s. And at that point, the Social Security Administration may only be able to pay out a certain number of pennies on the dollar of your benefit. So for example, if you're promised a $1,000 Social Security benefit at full retirement age, maybe they were only going to be able to pay out $750 or $800, 75 cents to 80 cents on a dollar if no changes are made. But the reality is, if you're on Social Security, you're receiving Social Security checks sometime in 2030, 2031, 32, 33, somewhere in there, and the trust fund ran empty because there was no political will to do anything about it between now and then. Checks will not stop. And the reason for that is because the government can raise revenue in ways that you and I cannot. They can tax the folks who are currently working and then use that to pay the benefits for the folks who are currently on claim. But let's talk about some of the potential changes. Some likely changes to the program could include either eliminating or drastically increasing the earnings cap. Now, maybe you knew this, maybe you didn't, but when you earn a paycheck, if you earn more than $137,700 in a given year, you don't pay Social Security tax on anything above that. Now, for those of you who are high income earners, if you look at your green and white statement on page 3, you're going to see a list of all of your earnings years, your earnings record years. And you may see some years where your payments into Medicare are higher than your Social Security contribution. And that's because you've hit that earnings cap. For those of you who didn't hit the earnings cap, you'll see that number is about the same. If we eliminated the earnings cap altogether, and everyone paid Social Security tax on every dollar they earned, the system would be completely flush with cash on that one fix. And another way to amend the system a little bit to ease the burden would be to increase the full retirement age. For most of the folks who attend our classes, their full retirement age is somewhere between 66 and 67, depending on when they were born. Now, I'm 40 years of age, and my full retirement age is also 67. I have a 9-year-old son. Under current law, his full retirement age is also 67. So I fully expect that younger workers like myself and future generations like my son will have their full retirement age pushed out. Maybe it should be 69, maybe it should be 70, maybe it should be 72. I don't know. But I fully expect that to occur. I'm not convinced it's going to affect any of the folks who are either claiming Social Security now or near the age at which they're going to be claiming Social Security. Another likely change to the system would be to increase the payroll tax. Right now, 12.4% is deducted to cover payroll tax to go to Social Security. And half of that's paid by your employer and half of that's paid by you. And if you're self-employed, well, congratulations, you get to pay both. If they increase the payroll tax by 2.83%, that one fix on its own would completely flush the system with cash. I do think it's very likely that there will be some political will on both sides of the political spectrum to come together and make changes. And it will probably incorporate a combination of all three of these different levers that could be pulled. Any changes made to the program are unlikely to impact folks who are either currently retired or near retirement and ready to claim Social Security. But it's good to know that the system presents a very good opportunity for retirement income and to optimize that for your household, and that checks aren't going to stop. So let's talk a little bit about one of the questions that comes up often, and that is, what is the best age to claim? And it really comes down to, do I claim early or do I claim late? If I claim early, I get smaller checks because I take a permanent reduction. If I claim late, I get an 8% credit for every year that I delay beyond full retirement age. So let's just look at this for a little bit. Assume that full retirement age for this individual is 66. At full retirement age, that person would get 100% of their full retirement age benefits. But if they claim early, and the earliest that person could claim is 62, that person would take a permanent reduction of 25%. In other words, they're only going to get 75% of their full retirement age benefit because they claimed early. And that is permanent for the rest of their life. If you wait to full retirement age in this case, though, you get 100% of your full retirement age benefit. And for every year you delay beyond that, you get something called a delayed credit. and that delayed credit is 8%. So you can optimize Social Security up to age 70 and get up to 132% of your full retirement age benefit for the rest of your life going forward. So there is an incentive to delay retirement. Now, let's just look at the difference between claiming early, the earliest option at age 62, and waiting until your full retirement age. We won't talk in this particular section, we won't talk about delaying beyond full retirement age. Just waiting from 62 to 66 in this case, and look at that comparison. We're going to make a couple of assumptions here. We have a benefit of $2,000 per month, and we're going to look at the cumulative value of those benefits over a lifetime. Now, if I claim at age 62, I'm going to take a permanent reduction of 25%. So that means that my $2,000 monthly benefit is now cut to $1,500. I'm going to get a 2% cost of living adjustment as an assumed cost of living adjustment on Social Security. And there is a cost of living adjustment each year. It's that cost of living adjustment is calculated and declared in October for the following year. So in October of this year, they will calculate and communicate what the new cost of living adjustment will be for the following year starting in January. So just keep that in mind. Every year, October is when that's calculated and declared. But we're going to assume a 2% cost of living adjustment for this example. Now, the cost of living adjustment is not on $2,000. The cost of living adjustment is on your benefit. And because we claimed early at 62, our benefit is $1,500. So we're going to get a cost of living adjustment on $1,500 going forward, not on the $2,000 full retirement age benefit. Well, we're going to assume living to age 90. That's 20 years of receiving monthly checks from Social Security. And our cumulative benefit is over $666,000. Now, money means different things to different people. That might be a lot of money to some folks, and it might not be a lot of money to other folks. But the reality is that Social Security is often one of the largest retirement resources that somebody has within their plan, and it's often one of the most mismanaged. Now let's look at a situation where we just wait to full retirement age. We're going to wait 4 more years. At that point, we get no reduction in our full retirement age benefit. We receive that cost of living adjustment on the entire amount. So $2,000 a month is the full retirement age benefit. We're going to get a cost of living adjustment on the entire $2,000 a month going forward. And we're going to assume living to the same age of 90. But we only collect checks for 24 years because we waited 4 years. The cumulative benefits are $730,000 at that point. That's over $63,000 of additional government-backed, inflation-adjusted, and tax-advantaged income. Now, that's worth repeating. Government-backed, inflation-adjusted, and tax-advantaged income. Social Security is the only source of retirement income that you're going to have access to throughout your entire lifetime that has those 3 characteristics in one income source. An insurance agent can't sell you more of it. A commission broker can't sell you an investment that does this. And as an investment advisor, all I can do is advise folks on how to optimize it for their household because it is the only source with those 3 characteristics. Now, what are Social Security benefits really worth? In our financial services industry, there's this thing called the safe withdrawal rule. And everybody has a different way of kind of determining what the safe withdrawal rule is. But we can tie this back to a gentleman named William Bingen back in 1994. He kind of did a research study and tried to nail down what is a safe withdrawal rate from a portfolio of stocks and bonds on an annual basis to have a pretty good chance of not running out of money over a lifetime. And his particular study kind of nailed down this 4% rule that has frankly become quite questionable under the circumstances that we're in today, the economic conditions today, because they're very different than they were back in 1994. But let's just for a moment apply that 4% rule and say, well, what would we have to accumulate in a pile of money, stocks and bonds, for example, to be able to produce the same level of income that we get from Social Security? So if we look at that $2,000 benefit again, you would have to amass a pile of retirement assets in stocks and bonds, a well-balanced portfolio, using the 4% rule of $600,000 in order to generate the same $24,000 a year income that Social Security is providing with a $2,000 monthly benefit. Now, if you have a husband and wife who have both claimed and their monthly benefit is $4,000 a month, which is quite likely if you have two spouses that had working records and you combine their two benefits, $4,000 coming from Social Security into a household is not uncommon. In that case, they would have to have over $1.2 million saved up in a balanced portfolio of stocks and bonds, applying the 4% rule to generate the same level of income for over a 30-year period of time or a lifetime. So Social Security is a pretty significant source of retirement resources. In this case, it's an income source. And it often, I think, is mismanaged because it's taken for granted. Until you really look at the cumulative benefits of Social Security over a lifetime for both both spouses, I guess is what I'm trying to say. If you're an individual, it's over your lifetime. If it's a couple, it's over that combined lifetime. You look at those cumulative benefits. They're often one of the largest assets that somebody has for retirement resources within their retirement plan. So, and often mismanaged because they are taken, I think, for granted, and there are so many different complexities when it comes to claiming Social Security benefits. Now, I'll just be candid with you. As an individual who spends the bulk of my time working with folks, trying to figure out what their vision for retirement is, how to organize their retirement resources, including income like Social Security or pension if they're lucky enough to have one, and their retirement assets like IRAs, 401ks, and other IOUs, the IRS, as well as their savings accounts and after-tax brokerage accounts, and trying to coordinate all of that to help them reach that destination that they're striving for. Income sources in retirement are so critical. Social Security, pension if you're fortunate enough to have one. Those are foundational levels of sources of cash flow coming into the household, because when you retire, you still need cash flow. You have money coming into the household, probably less than when you were working because you've transitioned from this full-time job where you're bringing income in, and now you have to still have the same expenses going out of the household to maintain your lifestyle adjusted for inflation. And so having those sources of income like Social Security coming in the household to replace that income that you had during your working years is very critical. And so getting that optimized income stream, whether it's Social Security or optimizing your pension if you're fortunate enough to have one, or creating additional sources of guaranteed income coming into the household to help you maintain that level, that lifestyle or that level of lifestyle that you're accustomed to, can be really, really critical. If you're trying to build that same lifestyle off of retirement assets that frankly are subject to market conditions and fluctuation in value, it can be quite disturbing, particularly in times of market volatility. So the more that you can, the better the foundation built on income sources that are consistent coming into the household, the more likely you are to be able to deal with volatile economic conditions and market conditions, et cetera. So the road through retirement is definitely paved with income sources. But before we make a claiming decision for Social Security, we have to look at a couple of things that are really quite important. Number one, what is your personal health history? Do you have anything in your personal health history that might lead us to believe that you might have a shortened life expectancy for some reason? Could be pre-existing conditions, or potentially maybe a family history of some particular life-threatening illness that could potentially shorten your life expectancy. That's important to consider. We also have to look at your marital status. Are you currently married? Were you married for 10 years or longer, but then divorced and haven't remarried? Are you widowed? All of those are considerations that have to be taken into account before you make a claiming decision. What is your employment status? Are you employed and earning an income? Are you retired, no longer earning an income? And this is a good jumping off point for that second question we get often, which is, can I earn an income and still collect Social Security? And what happens to my benefits if I'm doing that? Well, there are certain levels of income that you can earn in a given year, depending on how old you are and what your full retirement age is, without being penalized for Social Security. And If you are claiming Social Security before your full retirement age, and your full retirement age is based on when you were born, if you claim Social Security before your full retirement age, and you make more than about $18,000 a year in 2020, and this is adjusted each year. And frankly, you can Google search this or go online and find the answer. And it was different last year than it was this year, and it'll be different next year. But it's less than $20,000 a year at this point. And if you're making more than that, you're going to start giving back $1 for every $2 above that limit that you make. We call it the earnings test. So if you're making more than that and you're under your full retirement age, it may not make sense to claim Social Security benefits because you could just end up giving them back to Social Security. Now they'll get recalculated in your benefit calculation later on, so it's not like they evaporate and go away. But it just might not make sense to claim at that point. Once you turn full retirement age, however, you can make as much money as you want and claim Social Security benefits. You could be full-time employee, making tens of thousands or even hundreds of thousands of dollars, claim Social Security, and there's no penalty once you've reached full retirement age. However, that's the good news. The bad news is taxes can eat away at your Social Security benefits in that situation. If you're fully employed, making great income, and you collect Social Security, you could just end up subjecting a lot of your Social Security to taxes at your next highest marginal tax bracket. We'll talk about taxes a little bit later, but just keep that in mind. So these are all really important considerations to think about before you make an irrevocable claiming decision. Now, most of the folks that we talk to are very familiar with their own worker record. That's that green and white statement that you get. That's your retirement benefit. But Social Security is actually made up of a couple of other different components. You've got a spousal benefit as well as a survivor benefit. And a great strategy makes use of all three and coordinating those. We're going to talk about the survivor benefit a little bit because the survivor benefit is a really important component of Social Security. Generally speaking, when you have a husband and wife, for example, when one of them passes, the survivor is entitled to the higher of the two Social Security benefits. So for example, we have a husband and wife. One has a $2,000 a month benefit. The other one has a $1,500 a month benefit. When the first person passes, and it doesn't matter which one, the surviving spouse will retain the $2,000 a month benefit, but the $1,500 benefit for the lower wage earner will drop off. Now, the reality is 80% of women actually survive their husbands by an average of 14 years. 98% of the widow benefits are received by women. So this is really a women's issue. We hear a lot of gentlemen that will come into our office and say, oh, I want to claim now. I want to get the getting while it's good. I want to make, I'm going to claim early so I can get my fair share. And oftentimes they are the higher wage earners because they didn't have to stay home and raise children. There are a lot of reasons for that, but I'll just be candid with you. It can often be a very selfish decision to claim early when you could make a selfless decision to optimize a survivor benefit, which is likely to be received by the younger spouse. So when and how you claim Social Security benefits shouldn't be made in a vacuum as an individual, but more so as a household, and how are those benefits going to not only impact you, but also the surviving spouse. And if you happen to be the one who is more likely to be the surviving spouse, you may be the younger spouse, and maybe you're the higher wage earner, maybe you're the lower wage earner, but don't let somebody else make these decisions without having that discussion first, because what we often see is that a higher wage earner, male, husband, claims early, permanently gets a reduction in benefits for the rest of his life. But when he passes on a much smaller survivor benefit to his spouse, who's likely to live much longer than him. And that could be a really selfish decision. We're going to talk about a few strategies that folks can use, both married couples as well as those who were married for at least 10 years and then divorced. So when we talk about these strategies here in a moment, just realize that everything we're covering could apply to both married couples as well as those who are divorced. And frankly, if you are divorced and you were married for 10 years or longer and you haven't remarried, you don't even have to interact or involve your ex-spouse. These opportunities are completely independent of your ex-spouse. Now, if you really want to know what is my optimal claiming age for Social Security, just make a note, write that down. At the end of the class today, we'll give you an opportunity to talk to us about that. We're going to talk about married case couple number 1. And in this particular situation, we're going to talk about a strategy that is kind of being phased out. It really only applies if one of the spouses was born prior to January 2nd of 1954. That's a very important date, January 2nd of 1954. And in this case, John, who's age 65 beginning in November of 2018, he was born prior to 1954. So this strategy applies to this couple because one of the individuals, in this case John, was born prior to January of 1954. Jane, on the other hand, is age 61. She was born after January of 1954. Now, should they both elect their benefits as early as they can, or should they take a more optimal strategy? And we'll explore that. We have to make a couple of assumptions here first. First of all, John's primary insurance amount, that's what PIA stands for. John's primary insurance amount at full retirement age, or FRA, is $2,500. So if John pulled up his green and white statement and it said next to his full retirement age, here's what you're entitled to if you claim at your full retirement age, it would say $2,500. Jane's would say $1,300 on hers. We're going to assume one of them lives to age 86, then one of them passes away, and the survivor continues to receive benefits. The higher of the two benefits, transitioning to that surviving spouse for another 4 years. And cumulatively, we're going to look at what their benefits would be over a lifetime. So in this case, if they both claim as early as possible, they both kind of make the same decision that about 80% of the population makes, which is claiming as early as possible or age 62. They would have about $893,000 of government-backed, inflation-adjusted, tax-advantaged income hitting their household, which is nothing to turn your nose up at. It's a pretty significant retirement income source. But if they want to get an additional $132,000 of that very special income hitting their household, they need to know how to make a good claiming option or good claiming decision for their family. Now, what is the strategy that they would imply? Well, and we talked about this a little bit ago, that the longer you delay, the better off you are, right? If you wait from age 62 to full retirement age, you don't forfeit any of your benefits. If you wait beyond your full retirement age, you can get a delayed credit of 8% each year that you delay. So waiting makes a lot of sense. But in this case, we're going to have John file a restricted application for spousal benefits at age 66. He's going to get about $650, or half of his wife's full retirement age benefit, because that's what he's entitled to. Now, this happens for a couple of reasons. One, he was born prior to 1954, so he can take advantage of this restricted application. If you were born after 1954, you're not going to be able to do that, okay? But he is, so he can. Number two, he has to hit full retirement age first, and his full retirement age is 66. So he's able to do this claiming strategy at his full retirement age, 66, because he was born prior to 1954. He files for a restricted application to receive only his spousal benefits. That's going to allow his worker benefit under his own record to accrue at 8% each year, even though he has cash flow coming into the household. Now, he'll file for his own benefits on his own record at age 70, and by that time, they'll be worth about $3,700, almost $3,800 a month. The last thing that has to happen for John to be able to do this is for the spouse to file, because John cannot claim a restricted application on a spouse's record if that spouse has not filed. Now, in this case, Jane has not reached full retirement age. And we mentioned earlier that you don't typically want to forfeit those benefits, but sometimes it makes sense for one spouse to claim early and forfeit some benefits, and sometimes it makes sense for one spouse to delay. In this case, Jane files at 62 and 5 months. That actually opens up John's ability to file a restricted application and receive that cash flow. So they get the combined cash flow of her benefit at a reduced amount at 62 and 5 months. They get John's spousal benefit coming in because he claimed a restricted application, and then he switches to his at age 70. And that's how they get an optimal income from Social Security for their household. Now, the second example we're going to use is an example in which neither spouse was born prior to January of 1954. So a restricted application or a switch strategy is not an option here. In this case, they're going to use a timing strategy. Who goes first and who goes second plays into a good strategy versus suboptimal strategy. So in this case, Jack is 63 in January of 2016. Diane's 61 in 2016. How can they maximize their benefits? We're going to assume John's PIA at full retirement age, or primary insurance amount at full retirement age, is $2,400. Diane's primary insurance amount at full retirement age is $900. One is living to age 85. Then one of the spouses passes away, and the survivor collects the higher of the two benefits for another 5 years until age 90. Now, if they both claim early, the earliest possible, so each one of them claims at 62, they'll have $710,000 of cash flow hitting the household. However, if they take a more optimal strategy for their household, they could collect another $122,000 of cumulative lifetime benefits by making a better claiming option. So what's the strategy that they would use? Well, in this case, Jack can't take advantage of a restricted application. Neither of them can because they were born after January of 1954. But Jack is going to delay his benefits because he is the higher of the two earners. He is the higher wage earner between the two. His benefit by age 70 will be approximately $3,800 a month. Diane is actually going to file for her full retirement age benefit at 66 and 6 years. So she's going to file before Jack does when she reaches her full retirement age at 66 and 6 months. By that time, her benefit would be approximately $1,000 a month because of the cost of living adjustment. Now at age 68, when Jack turns 70 and he files on his own worker's record, Diane then is eligible for a spousal benefit on top of her own earner or her own worker's benefit. So she's been receiving her own benefit on her own work history, but when Jack files, she will be entitled to an additional benefit on top of that because her benefit is less than half of his full retirement age benefit. So now that he's claimed, she's eligible for this additional benefit, but she's going to have to talk to Social Security in order to get it. If you really want to know what strategy will optimize my household's Social Security checks for you and your spouse, just mark that down, write that down, and we'll make sure to give you an opportunity to talk to somebody about that at the end. Now, some of the bigger questions we get in our office are things like, well, what if I go first? What if I don't die on time? This is a chart showing the death ages of a couple. And for every couple, this pattern is different. And every time we run a report or analysis for somebody, this pattern looks different. But as you can see here, if they both die before their life expectancy, it might have made more sense to take an earlier claiming option. But if one of them lives to life expectancy, just one, not both, just one, they would have been better off with a more optimal claiming strategy besides claiming early. So we always look for a pattern that's going to optimize it for the client's household. Another question is, well, how do I coordinate my retirement resources outside of Social Security with my Social Security benefits? Now, if you take a claim early strategy with smaller checks over a longer period of time, you might get a pattern that looks like this. One spouse claims and receives benefits in the household, and the second spouse claims. You can see it jump a little bit. But there's always this gap between what we need to maintain our lifestyle and what we get from Social Security. And it's somewhat constant all the way through, although the cost of living adjustment on Social Security, we estimate that to be a little bit slower than the rising cost of goods and services. So you'll see the retirement need or what you need to maintain your lifestyle kind of increase a little bit faster than Social Security. There's still a consistent gap all the way through. When you take a more optimal claiming strategy, you get a very different pattern. You might actually end up with a situation where when you optimize Social Security for your household, it might cover the majority of your retirement income needs. But in order to optimize Social Security, you might have to actually use some of your other retirement assets early on in order to delay and make a more optimal claiming decision. So really working with somebody who understands how to optimize Social Security, the different strategies, and how to deal with these patterns and set up your retirement resources to be able to allow you to take advantage of them is really, really critical. If you want to know how will my Social Security benefits fit into my overall retirement income plan, you can write that down and we'll give you an opportunity to talk to somebody at the end. Now, why not just ask Social Security Administration or the Social Security Administration about these questions? Well, it's a matter of perspective. The Social Security Administration folks are going to do the best job they can to get you the highest benefit that you're entitled to the day that you file. They're not allowed to give you advice on how to claim or how to coordinate with your spouse, and they're not allowed to coordinate your benefits with your outside resources. It's not that they don't want to be helpful, they do, but their scope and their perspective is very narrow in what they're allowed to do and what they're going to do for you. As a fiduciary investment advisor who specializes in retirement planning, my perspective is, well, how do I coordinate your Social Security benefits, yours as well as your spouse's or your ex-spouse's, so that we can optimize all of your retirement resources to get you towards that vision of the future that you have. And it may be very different than what you're entitled to the day that you talk to Social Security. So it's just a matter of perspective. Now, one of the things that comes up often is the question of taxes. Will my Social Security benefits be subject to tax? If so, how much of my Social Security benefit will be subject to tax? How is it calculated? So we're going to talk about that a little bit right now. Now, benefits are taxed differently at Social Security benefits rather are taxed differently than your regular income. Number one, we have to determine whether your Social Security benefits are going to be subject to tax or not. And we use a calculation called provisional income in order to determine that. So we take half of your Social Security benefit, we set that aside. And then on top of that, we add ordinary income. So if you went to work today and you earned a paycheck, that's ordinary income. And you think about after you retire and you're no longer earning a paycheck, you must not have any more ordinary income coming into the household because you're not earning an income. Well, that's not actually true. If you've contributed to pre-tax accounts like IRAs, 401ks, or other IOUs to the IRS, and you make distributions from those accounts in order to supplement your Social Security benefits throughout retirement, that is considered ordinary income. Even though you didn't actually put your boots on that day and go to work, you still have income coming into the household that's considered ordinary income. So we take Social Security, we take half of that, we add ordinary income, including distributions from traditional IRAs and 401ks. On top of that, if you have any pre-tax account or after-tax accounts, say a brokerage account with stocks and bonds, and they're turning out capital gains and dividends, we add that on top. And last but not least, tax-free interest from municipal bonds, and that gets added in. So you take all of that income, you add it together, and that's how we determine whether or not any of your Social Security benefits are going to be subject to tax. It's called provisional income. Now, a couple of sources of income that are not included. Number one, Roth IRAs. Roth IRA distributions are not counted in the provisional income calculation. So if you think about this, if you've got quite a few years before you're going to make that transition from your working years to your post-working years, and you have some time to plan, it might be a good time to look at potential Roth conversions. Does it make sense to convert some of your pre-tax dollars to never tax dollars from an IRA, for example, to a Roth IRA, pay taxes now, and then be able to distribute those later on in retirement after you've optimized Social Security for your household and not have them impact Social Security? So just to think about this for a moment, the Tax Cuts and Jobs Act of 2017 took effect in 2018. It effectively lowered the tax rates. So the 15% bracket became 12. The 24 became 22, 28 became 24. It also widened the brackets. So you have more capacity in each one of those brackets. So let's say, for example, right now you're earning an income and with your standard deduction for your household, you end up with, you're in the 12% bracket on the next dollar distributed or the next dollar received. Well, let's say you've got $40,000 between the 12% bracket and the 22% bracket. So you're not earning any more income, but you have this capacity in that 12% bracket before you hit the next 22% bracket in this case. What happens to that capacity of $40,000 of 12% taxable income that you're not taking advantage of? If you don't use it, you lose it. So it might make sense to do some conversions, understanding you're going to pay taxes on anything that you convert from a traditional IRA to Roth IRA, but it might make sense to do some conversions in that gap and filling that bracket up. We call that stuffing the bracket. And so it might make sense, depending on where you're at today, to make some strategic Roth IRA conversions, so converting from a traditional IRA to a Roth IRA, so it doesn't impact you in a negative way later on in retirement. Just something to talk to your tax planner about, or your financial advisor if you have one. And if you don't have one, this is something we're very well versed in. If you'd like to know, will taxable distributions from my IRAs, 401ks, other pre-tax accounts, we call them IOUs to the IRS, will any of those impact Social Security checks? And is there anything that I can do about it? If you want to know that, write that down and we'll give you an opportunity to talk to somebody about it. Now, the provisional income calculation helps us determine whether or not you're going to breach these thresholds. And if you breach these thresholds, some of your Social Security benefit could be subject to tax at your next highest marginal tax bracket. Now, if you have a married couple and your provisional income, which is half your Social Security benefit plus ordinary income, like distributions from IRAs and 401ks, capital gains and dividends, and municipal bond tax-free interest, all added together, if it's above $44,000, up to 85% of your Social Security benefit could be subject to tax at your next highest marginal tax bracket. We're going to run through a couple of examples just to let you see how this all works out. So let's say we've got a husband and wife, and they need $60,000 of cash flow to come into their household to allow them to maintain their lifestyle. They've taken a delayed strategy. They've optimized Social Security for their household. Maybe they spent some of their pre-tax money or filled that gap or worked a little bit longer, but they took measures to basically get higher checks, higher Social Security checks than lower ones. Because they made some good claiming options. Okay, they've got $40,000 coming in from Social Security. They need 60, so they're going to have to make some distributions from their IRA accounts, for example. In this case, we're going to keep it real simple: Social Security and pre-tax accounts like an IRA. So $40,000 coming in from Social Security. We've got $20,000 coming in from an IRA for a total of 60. The provisional income calculation takes half of Social Security benefit. So in this case, $20,000, which is half of 40. Adding in the IRA distribution of 20, the provisional income at this point is $40,000. Now, $40,000 worth of provisional income breaches the $32,000 threshold by $8,000. Now remember, if you breach that first threshold, half of your Social Security benefit then could be subject to tax. In this case, $8,000 that has breached that threshold divided by 2, or 50% of that, is $4,000. So $4,000 of their Social Security benefit is subject to tax at their next highest marginal tax bracket. Now, their next highest marginal tax bracket is said specifically that way for a reason. Sometimes we can do enough planning to get somebody in a position where they don't have to pay taxes on Social Security, but it's very difficult unless we worked with them for many, many years. But even if your Social Security benefits, like these folks, are subject to be taxed, or at least part of it, if you can control your next highest marginal tax bracket by doing some strategic tax planning, you can still reduce or potentially reduce the taxes you might pay on your Social Security benefits that are destined to be taxed at your next highest marginal tax bracket. So in this case, $4,000 are subject to tax at my next highest marginal tax bracket. I didn't breach the next threshold of $44,000. Therefore, only 10%, 4,000, of my $40,000 Social Security benefit coming into the household is subject to tax. Very small percentage. Now, if we take a different approach and we claim early and we get smaller checks, theoretically over a longer period of time, but we have to fill a wider gap because we didn't take a delayed strategy. We have $20,000 of Social Security coming into the household. We have to make larger distributions from our pre-tax IRA, IOU accounts. And in this case, we've got a provisional income that is half of Social Security, or $10,000, added on to the $40,000, which is a distribution from our pre-tax accounts like IRAs. That gives us a provisional income of $50,000. Did we breach the first threshold of 32? Yes, we blew all the way through it. So from 32,000 to 44,000, that's $18,000. Half of that, or $9,000, is subject to tax at my next highest marginal tax bracket. We actually launched through the second threshold as well, and about $6,000 above that. So we've got another $2,100 that's subject to tax at my next highest marginal tax bracket. That means that $11,100 of my $20,000 Social Security benefit is actually subject to tax at my next highest marginal tax bracket. That's about 55% of my Social Security benefit now is actually subject to tax at my next highest marginal tax bracket. And it's just a matter of how and when you distribute resources and how you coordinate your Social Security benefits with your other retirement resources, which unfortunately Social Security is not allowed to give advice on. So if you want to know how much of my Social Security check will be subject to tax at my next highest marginal tax bracket, and is there anything I can do about it, write that down. We'll give you an opportunity to talk to us here at the end. Now, a couple of questions to ask yourself before we part ways today. Do you believe that Social Security planning and tax planning is a very important component of a well-designed, comprehensive written retirement income plan? And do you believe that you deserve a second opinion? Maybe you're working with a CPA or tax planner right now that you're very comfortable with. Maybe you've got a terrific advisor, or you're doing it yourself, but you're just not getting questions answered to these particular topics, and there's really no planning going on when it comes to Social Security or tax strategies. It might be worth getting a second opinion and talking to somebody about it. Because you attended this workshop, you spent time with us, you showed an initiative to stick all the way through this and try to become better educated for yourself, your family, and your future, we'll make an offer to you. We would typically charge $2,400 for our PT5 retirement plan screening. That's a comprehensive screening which includes Social Security analysis for your household, a complete investment analysis where we look at what do you own, what are you paying for what you own, and what are you getting in return for what you own. I think everybody should know that. Chances are, if you have a streaming service like Netflix or Disney Plus, you probably know exactly what you're paying, and you probably know exactly what you're getting. But most folks, we find, have no idea what they own when it comes to their investments, nor do they have a clue as to what they're paying for what they own or the advice that they're getting, and we think that's really important. We'll also look at how everything coordinates together based on the vision of your future that you've described to us, and how are your resources coordinated today, and are they going to get you there? And if we see any problems, we're going to say something and let you know. Typically, we charge $2,400 for that. The only way to get that waived is, number one, you attend one of our live classes, or you watch this video and you've got to the end and you decide in the next 24 hours you want to take advantage of that, so you contact us. Or you get referred to us by one of our valued clients. Those are the only two ways we're going to waive that $2,400 fee. If you walk in off the street, or you come to us through our website and you did not attend one of our live classes, or you did not attend this broadcasted version, you can expect to pay $2,400 for us to perform that service. What you'll walk away with is a complete comprehensive analysis on your Social Security benefits, which will tell you what is your earliest claiming option, your most delayed claiming option, but more importantly, what is the optimal claiming option, in our opinion, for your household to coordinate with all of your other resources. We'll do that investment advisor analysis, as well as an investment advisor opinion letter detailing what you own, what you're paying for what you own, and what you're getting in return for what you own. And how does all of that coordinate together in a comprehensive written income analysis? If you'd like to take advantage of that opportunity and have that $2,400 waived, again, you can be referred to us by one of our clients, attend one of our live classes, or in the next 24 hours, contact Brianna at 515-528-8632 and schedule a consultative discussion. We can do it by phone, or we can do it by video conference if you choose to do it that way, or if you feel comfortable, you can come into the office. We'll just spend some time to get to know each other and see if this is going to be a fit for you. You can also reach us at info@triplett-westendorf.com, or find us online at www.triplett-westendorf.com. There's a place there to request more information, and you can request to schedule some time. But the best way is really just to pick up the phone, contact Brianna at 515-528-8632. Let her know that you attended this broadcast. You'd like to schedule some time to start that process and have that fee waived because you attended this class and made it all the way to the end. We appreciate your time. Hopefully you found some value in this class today, and you learned one or two unforgettable ideas that you can apply in your own circumstance that'll leave you in a better position now than when we first met at the beginning of this broadcast.